Let's talk money. Money, 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 and financial freedom. Today, I have the opportunity to talk to my friend America via Zoom. Some of you may recall meeting America during our girls' trip to Florida. Dr. America Foster is a family doctor, licensed financial educator, and registered Social Security analyst. Today, Dr. Foster will be giving us some valuable information about how to better manage our finances and how to strive for financial freedom, especially if you are a parent or even a college student or even a grandmother looking towards retirement. She'll be sharing some valuable information. We'll talk about retirement, life insurance, taxes, and financial issues like that. So we hope you'll be inspired after this conversation and learn something new. All right. Welcome, America. Welcome,
Hi.
welcome. For those who don't know or don't recall, hopefully you saw her before when we went to our girls' reunion trip in Florida. You met her. She is a primary
Yes.
care doctor and a financial advisor. Is that right, America?
So I am a financial educator and
Okay.
a registered Social Security analyst.
Okay. Awesome. And so many people after that video that we did in Florida, so many people wanted to see America come back to talk about finances and, someone relatable. And so that's why we have her back. So if you are interested in finances, in taxes, in retirement, in investment, stuff like that, right? She is well versed on that information. So, but before
Yeah.
we get into the nitty gritty, for another question I got so much of was, where's America from? Like people were guessing back, left, and right. Where is she from?
Yeah. So I was actually born in Panama and my family migrated to the United States when I was about 9 years old. So I do speak fluent Spanish.
Okay.
And so yes, Panamanian, Central America.
Okay. Also, tell them a little bit about your education for those that may not know.
Well, I pretty much went to school here in the United States.
Right.
I did my high school in the Bronx, and then we went to college together. Where
Right.
I met you the last year of high school because we did that Bridge to Medicine program together,
Right.
and Cornell together for those years, and then I went to the University of Vermont where I did my medical school.
Mm-hmm. Mm.
And I did my residency, the main Dartmouth program, and that's where I graduated from med school. I'm a family practitioner,
Okay.
and I've been doing that for 20 years now. Oh,
Wow. Wow.
to
Wow.
me, it just seems like yesterday. So
I
it's
know. I
crazy that
know.
it's been.
Yeah, and it's crazy because sometimes I think I've known Kenton my entire adult life, but honestly, I met you before I met him. Right.
Yeah,
I've
that's
known you before
that's
I met
true.
him, and that's been like 30 years. Okay, so
Yeah, it's
America,
true.
what made you go from medicine or, practicing medicine to wanting to become a financial advisor? I keep saying financial advisor. I should say financial educator.
Financial educator. Well, a lot of the people that I see in medicine, people
Right.
come in there and one of the number one diagnoses that they have is they're always coming with depression, right? So you
Right.
talk to them, what's causing them to be depressed. And when you get down to it, you
Right.
realize that a lot of their issues had to do with finances.
Mm-hmm.
And so I decided, well, you can give medication for the depression, but if you don't get to the root cause of what's causing them to be depressed, yeah, you're not
Right.
really helping them. And so that's
Right.
sort of how I made not a transition, but an addition to
Mm-hmm.
my career because I still full-time practice medicine, but I
Wow.
also part-time practice financial educating. And I go all over. I talk to people in their homes. I do a lot of events in the library. I do a lot
Okay.
of, wherever people need me, I go and I talk to them about finances. And by the
Wow.
way, finances is a difficult subject to broach with people because, people,
Right.
there's a lot of stigma, right? It's one of the
Right.
things you don't talk about.
Right.
You don't talk about politics, you don't talk about religion at the dinner table, and then finances
Right.
is the other taboo
Right.
subject that you don't talk about. But,
Right.
if you don't talk about it, you don't learn.
And especially, I think, as women, one, not getting the financial education, but two, being told like, yeah, there's no, it's not appropriate to talk about money, and also perhaps the shame associated with either not managing your money right, or not having enough money, or
Right.
struggling, financially. I definitely think culturally, in many places, there's sort of a stigma or shame attached to it. Right.
Yeah, you're definitely right. The shame, the embarrassment, people don't
Mm-hmm.
want to really bring it up. But truly, Habiba, if you don't talk about money, how would you know, like, what
Mm-hmm.
raise to ask your boss for? How
Right.
would you know how much to pay for a home? Like, you're buying a home, you wouldn't really know what the home is worth if you're not really talking about it.
Mm-hmm.
How would
Mm-hmm.
you know what the proper protection is for your family? When it comes
Right.
to doing your life insurance or your
Right.
disability insurance. Yeah, it's just so much that you need to know, and talking about it is how we learn. And once you
Mm-hmm.
have that education, you can do whatever you will
Right.
with the knowledge. But you just have to have the knowledge. Knowledge is power. We've always.
Right. Absolutely. I don't know if you take clients, or is it more of sort of group seminars? What's the most kind of common concerns or issues that, when people come to you, or when you go to speak to people?
Yeah, well, usually I need to talk to them about the proper foundation. I think people, like building a house, you definitely have to start it from the bottom up. And
Right.
most people, when they have money, their first thought is, oh, let me put it in the stock market, right?
Mm-hmm.
Protect your income. You need to protect your assets, and you need to protect your life. So in case something happens to you, what happens to your family? If you
Mm-hmm.
lose your life, how does your family go on? And that's actually sort of the reason I got into it also, is that
Right.
I did have a patient, and the patient was the breadwinner, and
Mm-hmm.
all of a sudden, COVID was a part of his life. And unfortunately, he lost his life. But
Wow.
because of him not having any insurance or anything in place, what
Right.
happened is that his family got deported back to their country because they could
Mm.
not afford to be here in the United States. And, he
Okay.
always wanted to be buried in his country. And
Right.
it didn't happen. He didn't get his final wish. They just had to cremate him here because
Mm.
nothing was in place. They never
Right.
talked about it, right? So nothing was in place and everybody suffered. So protection is the number one thing that you have to have in place. Disability insurance, life insurance, health insurance,
Mm-hmm.
all of that has to be in place first.
Mm-hmm.
What else do people want from me? My
Mm-hmm.
very favorite is to get people out of debt.
Mm-hmm.
My
Mm-hmm.
favorite thing to do.
Right.
Debt management is a big deal. And
Right.
so, we have like workshops, and we teach people the debt roll up, how to actually get themselves out of debt. If you have extra money every month, you're paying out several debt. You don't throw
Right.
the money willy-nilly. There is a process and there's a way to get in. You just have to be consistent,
Right.
disciplined, okay, to
Right.
get out.
So let's say your client is a single mom, for example, and doesn't have any disposable income, or doesn't have extra money like that. She's struggling. Maybe she makes, I don't know, about 30,000 US dollars. How does and she has four credit cards, and she has loans, and she wants her children to go to college, or where does she start, in general? Where does she start? I know it's going to be different for every person.
Yeah. It's going to be different for every person. But again, life insurance, there's term life insurance, which is temporary insurance, but it's definitely affordable for the people that can't buy into a permanent policy. But you
Mm-hmm.
have to protect those kids. The one thing you said, and it's really important, if anything happened to her, she still want her kids to go on to college, right?
Right.
So you have to have some protection in place in case something happens. So always you want your kids to still live indoors, even though you are no longer around to take care of them. And then,
Right.
debt brings um a lot of issues with it, right? And who's going to take care of the
Right.
kids and all that? And people are reluctant to take on additional, because it's heavy to take on
Right.
other people's children. But if there is the money already in place for them, they can have a place to live. They can have their college education already paid for. It's
Right.
easy. Yeah.
Right. Right.
Like you said, everybody is different and
Right.
work for people. We meet them where they're at.
Mm-hmm.
Yeah.
Now, you talked about, or you mentioned life insurance. So I imagine there are different types of life insurance,
Yes.
such as, I mean, I don't know, like you said, term insurance. For someone who knows nothing about life insurance, what would be the different categories, pros and cons, just sort of briefly?
Yeah. So there are two basic life insurance. There's temporary insurance and there's permanent insurance, right?
Okay.
So the temporary insurance is for a period of time. So you can buy temporary insurance for 10 years or
Mm-hmm.
20 years. Those tend to be much more affordable.
Mm.
And you mentioned a 30-something-year-old lady with the kids making $30,000 a year.
Right.
So for her, yeah, she may want, if she has no extra disposable income, she may want to look into something like a term insurance that is going to
Okay.
protect her for the next 20 years, the next 30 years. So if anything happened during that time, she has it. Then there is permanent insurance, and these tend to be the whole life insurance policies, or the universal index universal life insurance is
Right.
also a permanent insurance. You know how when you go to Walmart, and you pretty much get everything under one roof. You can get your medicines there, you can
Right.
get your food there, you can get your household
Right.
items. That's kind of the same with the index universal life insurance. The permanent insurance is a way you can build your
Mm-hmm.
finances. Most people think about insurance as like death insurance, but with an index universal life, you can structure it
Mm-hmm.
where you can also have long-term care insurance. So if you need that money to take care of you, you lose the ability to do two of your ADL. You can no longer feed yourself. You can
Mm-hmm.
no longer bathe yourself. You can't toilet yourself or whatever. And you need someone to come in to help you do those ADLs. You can
Right.
take that benefit and turn it into a living benefit.
Okay. So
And the
so you can
best
kind
part
of
of it that
liquidate that
people
money. Is that
really
what I'm
don't know
hearing?
is that, yes, the money that's built up in that policy, you earn cash value. Yes. So that money, if most people can save money in that account and use it as a retirement account. So you
Mm-hmm.
can have 100,000 to whatever amounts of money you have
Mm-hmm.
for retirement. You can take that out whenever, 90% of that income.
Right.
You can take that out and you can use it. And the best part about it is that it's tax advantaged,
Tax
meaning that
advantage. What does
when
that
you
mean?
have $100,000 in that account, you take out 100,000. Yeah, meaning that the money that you take out of that account, you pay no taxes on it. So over the time, the money grows in that account,
Mm,
and the money grows because it's a protected sort of account. And
right.
when you take out that money, it is your money. It's sort of different than a 401k and a
Right.
403, which people understand. Those are tax deferred. So you
Mm,
put money in those accounts having paid no taxes.
right.
That money grows 30 years, 35 years. Let's say you have a sum of $100,000 that you built up over those
Right.
30 years. And it's time for retirement now. And
Right.
you go to take that money out. You still have not paid taxes on that money. So your $100,000 really is not $100,000. Whatever
Right.
tax bracket you're in is reduced
Right.
by that amount, because you still have to pay taxes on that. And
Oh, okay.
so that's a tax deferred, but the tax advantage of a
Mm,
index universal life policy, that $100,000 is $100,000. You take out that money, you pay no taxes.
I see. I see. Again, maybe a 30-year-old, 30, 40-year-old to know who is new to the US or an immigrant here that you think might be valuable information about taxes.
In regards to taxes, when you're saving your money, there's really three places that you can save your money in the United States. Three different accounts. We talked about the tax deferred account, which is
Okay.
like your 401k, your 403b. We talked about that is your health savings account. A lot of people have that through their job. It's
Mm-hmm.
your life insurance policy. And then there's a Tax Now account. Now, we are all familiar with the Tax Now account because those are like your bank accounts, your checking accounts. The money you
Oh,
put in there,
okay.
any interest you gain on those, right? Any interest you gain on those, you have to pay taxes on that.
Right. And it
Now,
tends to be minimum interest anyway.
that's the problem, right? Because there's really no growth when you put money
Right.
in the bank. So you asked before, what are people most interested in? Well, they want their money to double. They want to see their money grow. They want their money to work for them. You know, Albert Einstein gave us that rule of 72. Have you heard of that before?
No,
The rule of 72? Yeah.
no.
So the rule of 72 is the time it takes for your money to double. So there's a little computation. You got to do math now,
Oh,
right?
okay.
You have to take the number 72 rate you
Right.
get from an institution. So let's say you get 8% interest rate. Now the bank's not giving you 8%, but you take 72, you divide it by 8, and the
Okay.
number you have is the time it takes for your money to double. So if you
Wow.
have an 8% interest rate,
Right.
72 divided by 8 is 9. It takes 9 years for your money to double. If you have
Wow.
a 10% interest rate, 72 divided by 10 is 7.2. It takes 7.2 years for your money to double. But you
Right.
mentioned before that the bank is really not giving you any
Right.
sort of interest. Let's say the bank is giving you 1% interest. How long is it
Right.
going to take for your money to
I
how
guess
long?
72 divide by 1.
It's 72 years for your
72
money to
years. That's
double.
crazy.
So that's going to take 72 years. So, you know, we teach people where to put their money, where their money is actually going to double quickly for them and double as fast as possible.
Right.
You know,
Right.
yeah,
Right.
the things that
Right.
people really, you know, it's not out there. This information really is not out there. We went to Cornell and we never got any
Right.
financial,
Right.
right? You know, we're
Yeah,
going to,
no, definitely. Because I definitely made sure with my children who are in college, I said, make sure you take a finance class or something along that line. Not even accounting, but finance and stuff like that, because I know I didn't learn that in college. And it's
Mhm.
almost like when you come out running a business, you might have an idea about a business that you want, but no one actually taught you how to run the business, which is completely separate, you know.
Yes, absolutely right. Absolutely
Right.
right. Right. So you have to
Right.
really look for ways to get educated. It's good that you
Right.
told your kids those classes. It's important.
See, I got a quick Q&A or questions that I saw from the last video, just so that they know I saw the questions and that I'm actually asking you. What do you think about people who think it's normal to have debt, going into old age? Some people just think it's normal that they're going to die and leave debt or have things like 20 credit cards. What do you think about that?
I mean, it's very common. I mean,
Right,
we really see that. You know, there's something called the income gap, right? So 50% of the United States population fall on a line that's straight across. Over the last 30 years, they have built no wealth.
right.
50% of the US population have built no wealth.
Mm,
And then there's the top 1%ers. Everybody know about the top 1%
mm,
income, you know, that had the highest income.
right.
So this 1% group own the majority of the wealth, right?
Mm-hmm.
And then, so you have to think, well, why is that? How do the rich continue to grow rich while the poor continues to stay poor or grow poorer?
Right.
It's because we have bad habits and many of those bad habits add up. Like number one, we don't budget. Now,
Mm-hmm.
Habiba, every single dollar that you make
Mm-hmm.
has to have a job. If you don't give that dollar a job, then the
Right.
money is just going to get wasted. And you're
Mm-hmm.
right, people do. The old industry said that you borrow now and you pay for it later, but that is sort of the twisted mentality because the rich get richer because they do not have those
Right.
bad habits, right? They don't buy into credit card. What they do is that they get financially educated. They build over long periods of time, and then they just are very consistent and disciplined, and that's
Right.
how they build their wealth, and they pass it on to their generation get
Right. They pass
take
it on to their
advantage of it, and
children. I'm wondering if part of the blame is the American culture that teaches, people
of course,
to spend, 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 and that somehow you're rewarded if you have a higher credit depending on how much more you spend.
Yeah. And then also when they have credit card debt, most people then tend to pay it back with the minimum payment. But paying the minimum payment is not really helping get rid of that debt. Paying the minimum payment is just going to interest. So it
Right.
takes
Years.
it takes 30 years to get rid of that debt if you get a minimum payment. You see, this is the education piece that I help instill in people. And many times they get it. You know, they just come a point in time when people get it. And yes,
Right.
if you're born in a culture that just, you know, that is a way of life,
Right.
you know, that's a mentality that keeps us down. You know, you want people to learn and do better for themselves, so do better
Right.
for themselves.
What are common bad financial decisions we do when we're young?
What did you do when you got your first paycheck? What did you do?
I'm trying to remember my first paycheck.
What did you do, Habiba,
I
when
mean,
you
I
got your
think
first
back
paycheck?
then, I definitely feel like we were just living paycheck to paycheck. So saving was not even something I would have thought about. It was literally just about, do we have enough money, you know, for food and rent, you know? There wasn't much into financial planning. Let's
So
just
you
put
didn't,
it that way.
so did you splurge on a car? Did you splurge on
I
things
don't know if
of
we
buying like the
splurged.
best
I
outfit?
definitely think we were not the splurging type, but we did have things out of necessity. Like we definitely had a rented place, and at some point we've had cars. Yes, even when we were younger.
Yeah.
Not
Said
bought cars.
cars.
What do you call it?
That was a plural.
No, one
So you had
car. Actually,
cars,
no
right?
one. I don't think when we were
Oh, okay,
younger,
okay.
out of college, and for many years, did we ever have two cars. We pretty much survived with one
No,
car.
no, I meant like when you became a medical doctor, you started making
Oh, when I became a doctor,
um
yeah, I would say, yeah, I
yeah.
had my own car. And, you
Oh,
know,
okay.
we then eventually got a house type thing, did the typical American thing. But I think over the years, one big light bulb for me was this idea that mortgage is a fraud. I don't know. For me personally, I
Oh,
just
yeah.
got to this point where I'm like, so you think you have a house, but as long as you have mortgage, the bank owns the house. You don't have a house. Now, I don't know if that's kind of too extreme, but that's kind of the left that I went.
No, no, no. No, I get it. I get it because you still feel like the bank owns it. Well, I guess people feel that way with their cars as well. You know, that you have that
Right.
5-year note. It's not really yours until you finish paying off the note. So
Especially
people
when
do,
something devalues over time and you're still
right,
paying, you know, a large amount of money for it. You know, is it really yours? So
right.
I would say maybe I'm not a good example in that sense because, yeah, I went the other extreme where I was not
Yes.
very trusting of the institution.
One of the mistakes we make is that we don't invest in assets that grow in value. So yes, you're right. You talked about the car. Yeah, that depreciates in value. But the homes, though, homes
Mm-hmm.
tend to appreciate in value. So if you want to invest in
Right.
anything, that would be the place to do it. So,
Right.
you know, there's a difference between being rich and being wealthy, right?
Right.
I asked my sons the other day, oh, which do you want to be? And they're like, oh, I want to be rich, right?
Mm-hmm.
But being rich is only, you know, buying stuff that don't necessarily appreciate in value
Right.
as
Right.
time goes.
Not
The wealthy
generational wealth.
people, right? The generational wealth, yes. The wealthy people, they invest in things that is going to grow with
Right.
time. It might not be large now, but yes, you're right. For generations to come, they're going to experience the benefit
Right.
of the wealth and the good investments.
Insurance is a big subject because there's health insurance, there's life insurance, right? What are the kinds of insurance and which ones do you tend to focus on?
Well, I like the because again, the number one thing is protection.
Mm-hmm.
So life insurance, I definitely focus on that. We also, you know, help people with disability insurance. We help people, you know, we talked earlier about the temporary and the permanent insurance, but you know, getting some sort of insurance because you really have to protect your assets
Right.
and you really have to protect your income. So getting some sort of insurance is really key. And
Right.
you know, people tend to think that oh, insurance can be very expensive, but you know, that's why the one thing that we do with clients is that you do have to do a personal financial strategy with
Right.
your clients And that way you can know exactly what they can afford. Because you never want to put people into things that then, they can pay for it today and then tomorrow it's
They
for
can't afford. Right.
yeah.
Key points you would like the viewers to leave with.
Okay, so definitely key points. Number one, get your protection in place, your life insurance, disability insurance, health insurance. Number two, you need to get out of debt, because truly you don't want that burden on your back. The first time I paid for a car, oh my gosh, the freedom that you felt once that was paid off. You feel that way once you get out of debt. Number three, you have to build your emergency fund. Like, people don't think about their emergency fund, but we just all experience COVID together. You need at least 3 to 6 months of an emergency fund of your income, just in case, because things happen. And then when you have those three things in place, then you can think about investment.
Right.
So you have to start. So those are the key points. It's definitely important to have your budget. It's really important to try and stay away from credit card debt.
Right.
It's really important to, there's a difference between working for a living and then living to work. It's really a difference for that. So we have to figure out those differences. But the most important thing is that no matter where you are, if you're 30 years old, you have to be thinking about retirement. If you're 50 years old, you need to be, thinking about retirement, your children's education, all that. And starting now, the earlier you start, the less you have to put away in order to get to your goal in retirement. The later you start, the more you have to put away to get to your goal in retirement. So I tell people, start now. When you get your check from work, it's really important to pay yourself first. Most people make the mistake of paying the cable bill and paying the computer bill and paying all the Nintendo games and everything. They pay that first. And then whatever they have, they save that for themselves. You have
and
to
when you say save for yourself, you're not talking about go out and buy designer bags or buy material things in that sense for yourself. That's not what you mean.
Not saving. I mean, saving. I said you put it away for yourself.
Right.
No, that's buying. I'm saying saving. So you pay yourself first. Usually you pay yourself about 10% of your income. So if you make $60,000 a year, let's say, 10% of your income should be saved of that $60,000. So that's about $500 a month you should be saving. So pay yourself first, and then everything else comes after. You're the most important thing in your life and the life of your family.
Wow. Okay. Now, if someone was trying to contact you, do you do Zoom, or do they talk to you by phone? If they're out of state, what would you normally prefer?
A lot of the clients are out of state, so I do a lot of Zoom, just like we're doing now. I definitely prefer to meet people face to face, but with Zoom technology, we can definitely meet this way, and they will contact me with my business phone, which is 401-280-0609.
Okay.
And we'll set up a one-on-one. The first thing we'll do is a financial needs analysis. We want to see where people are, how much debt they're in, how we can get them out of debt, how we can start saving for their kids' college education and their retirement, right? We want to get them started, because most people the biggest step is that first one, and most people are like, oh, I don't want to do it, I don't want to talk about it, but I help them get over that. And once they get started, they see how their money is compounding and how they're doing good for their future. So it's a win-win for the client. They really see the light at the end of the tunnel, and that's
you don't have a minimum, right? Meaning, like, people think a financial educator, the person needs to already have a lot of money before they see you or before they consider you.
Oh, no. I mean, the education is that you need to know the money that you're going to make, where you're supposed to put it to make it work for you. You work hard for your money. Now it's time for the money to work hard for you. And you're right. There is no minimum. It might be $1 a day that you're saving. It might be $5 a day that you're saving. You just have to start. And that is the biggest, the biggest message that I want. So, I mean, you don't have to have extreme money, because people that have money, they're saving it somehow. But
Right.
if you don't have a discipline in place, I help lay out that discipline, that plan for you, because
Mm-hmm.
it's not, you put your money in today, you're going to take it out tomorrow. No, you don't want to be spend, spend, spend. I'm not saying that you are going to not have any fun. Yes, you're
Right.
going to have fun, but you're going to cut out things like, I help people stop smoking, both in my medical career and then also in the financial career. I show them how stopping smoking can be that $10 a day that they're spending in smoking
Right.
and buying cigarettes. Oh, that
Mm-hmm.
$10 a day they can be putting away for themselves. Just
Mm-hmm.
$10 a day. That's
Mm-hmm.
$300 a month. And then people spend money. If you sit down and write what you spend money
Right.
on, you are like amazed as to how much money go out
Where your
your,
money is,
your yes,
yeah,
every
leaking
day.
out of. Mm-hmm.
Coffee, people buy a lot of coffee. I'm not saying that you can't ever buy a cup of coffee from,
Right.
the local coffee, but you're going to cut it down so that sometimes
Mm.
you can buy the coffee and then the other times you're going to save that money. So that's
Now,
what I,
where do you help them put this money? Like if it's not about putting it in the bank, where's this money that they're going to save or invest in? Where is it going? What are options?
well then, yeah. So, people that you talked about, people that have money, sometimes we will consider like an annuity, because the annuity, is a place that would pay them later in life. We
Right.
consider the index universal life policy, where yes, it's life insurance, but it's also a place where you get high interest rate. Abiba, one of the things that people don't know is that when you put your money in the bank, you know what the
Right.
money do with the money you put in the bank? They take that money and they put it into a life insurance policy. Did you know
Mm.
that? Because they
Mm-mm.
know that the life insurance policy is very secure. There's
Right.
high interest rate. You can get interest rate like 15% in a life
Wow.
insurance policy. Each policy is different. So we will go over that for people. But yeah, and then you can have your long-term care and you can have not only a death benefit, but a living benefit. So yeah, so that's where we help people. Those are some of the considerations we have for people. So yeah, it's very flexible and people can definitely see the benefit that
Right.
the insurance policies can do for them. But yeah, but there's definitely annuities, there's the Roth IRAs that also give that tax advantage. So,
Mm-hmm.
we help people in whatever
Right.
way they need, whatever they're thinking about, we sort of help them as well.
And realistically, this is not something that obviously after one meeting is going to be a quick fix. I would assume, like in general, you
No,
might
no.
have an established relationship with clients or people, or what do you think?
Oh yeah, no, this is not a one and done. This is like a lifelong relationship that we establish.
Mm-hmm.
People's life change over time and we are
Right.
flexible and we change with them. So
Mm-hmm.
no, this is not a one and done. This is a lifelong relationship that I have with my
Mm-hmm.
clients.
Oh,
Yeah.
okay. Oh, okay. Awesome.
Yeah, they can definitely reach me on social media, but I really like the texting, the 401-280-0609. I mean, they can reach me that way as well. And I am on Instagram and I am on Facebook, of course. I really love what I do both in medicine and in financial planning and financial educating. And even with my registered Social Security analyst forum, I love when the lights in their eyes go off because they get it. They finally see what is going to work for them for their future. So it's always a pleasure. Went into medicine to help people, but I see that financial education, you help people in a completely different way, but it is definitely an enriching profession. And, you help people with their finances and they grow and they pass it on to the other generation, which is absolutely what I want people to do.